So good evening, everyone. Good evening, all our clients. Thank you so much for taking out time on a Thursday evening. And we are going to ensure that you have a wonderful time. We're going to get a lot of insights from Nilesh Bhai today. So thank you so much for this. I am Dr. Mukesh Jindal. I am partner at Alpha Capital. I have Nikhil Vikamsi also with me, who is partner and who heads our South practice. And we have a special guest today, Mr. Nilesh Shah. So what we have is, I'll briefly tell you about the format. We will have 30 minutes, whereby we'll ask Nilesh Bhai some key questions related to markets. And then we will open the session for Q&A, because I'm sure all of you have a lot of questions for Nilesh Bhai. So let's start. Before starting, a brief introduction on Nilesh Bhai, though I don't think he needs any introduction. He's a very, very popular face on the media and is the face of the asset management industry. But still, as a formality, let me introduce. He's the managing director of Kotak Asset Management Company. He's a member of the Economic Advisory Council to the Prime Minister. Has phenomenal experience of more than 25 years. Have worked at Franklin Templeton, ICICI, Access. Has super record. And yeah, that's Nilesh Bhai to you. So Nilesh Bhai, before starting, questions on markets, I have a personal question with you. And I had this question which I wanted to ask from you, for a very long time. So today I have this opportunity. Nilesh Bhai, as far as I remember, I first met you maybe around 18, 20 years back. This was in 2005, when you were the CIO of ICICI Asset Management Company. Now, 20 years has gone. I think you still look almost the same. You're growing younger with the age. And, I think I should say that you're like Anil Kapoor of the asset management industry. So what's, you are not growing older. So what's the secret of your, youth, and how are you so cheerful, and, how do you have so much of energy?
So being a Gujuba, it was difficult for me to practice this. But Nikhil will understand. Kam khao, gum khao. That is the secret.
Last time in our call which we had last year, remember we had mentioned that you are Bollywood has one bhai and asset management has one bhai, which is Nilesh Bhai. And now today, Mukesh has also made you Anil Kapoor. So I think slowly you're taking all the chairs of the important Bollywood industry in the asset management industry, Nilesh Bhai.
Absolutely, Nikhil. I completely agree on this. So let's come to the markets, Nilesh Bhai. I have a very important question, and I think this is going all in the minds of all our clients over here. Has been 18 months, since equities have not delivered return. Last 1 year, we started 1 year back when we did the session. Markets Sensex was at 60,000. Today, we are still there. And it has been a, volatile year. We had the Ukraine crisis, the Fed hikes, and all sort of crises. We had the US banking crisis. Now, one simple question, are we done with all these crisis situations, or there's something unexpected you see happening in the market?
So Mukesh Bhai, we are betting on a very tricky pitch. The pitch is capable of producing bad delivery. For example, will Fed stop at the right time, or will they end up raising rates more than needed? There is always that risk. Can Russia-Ukraine get settled as Macron and Xi Jinping are meeting? Or it will get escalated, who knows? In India, we have general election in 24. Market today is expecting stability of government, but can we get a surprise like in 2004? So there is no way we can predict whether the bad news have ended or whether bad events will not happen or not. I think what is in our control, if there is a bouncer, should I duck or should I hook? If there is a outswinger, should I leave it or should I square cut it? So I have no control over what kind of ball will come. All things in my control is how do I react to it.
That's true. That's true, Nilesh. But I think it's more, it's no one's call in terms of prediction. But last it's been now I think over 2-3 months. The news of the word in the market is recession. Whether we see global, Europe, US, across, and obviously India is no standalone. We have a lot of export, not only exports, but even software services. So what is your view on recession? Is it over? Is it coming? Uh, your take on recession?
So, Nikhil bhai, my view is that central bankers will act like a Bollywood hero. Normally, if you see those scenes, they take the car to the cliff and then take a sharp U-turn. Today, central bankers are probably doing the same thing by raising rates, and world is fearing that we may roll over the cliff. But I will put my money that central bankers will apply the brake at the right time and take a sharp U-turn on interest rate movements. If rates come down on time and liquidity remains the way it is today, then recession looks very, very, very unlikely. For recession to happen will either require a escalation in war with Russia, Ukraine impacting energy prices, or will require a major supply chain disruption with a COVID kind of, disease. Bearing those kind of unexpected events, I think central bankers will rescue the world and we will see low growth, but not recession.
So that's somewhat a good news. We can take away that we don't see a recession for sure unless an uncertain global event unfolds. Till the time, I think we don't see a global or a national recession.
Absolutely. And from India point of view, for us, anything below 6% growth is recession. We have been left behind by others by such a big margin that I have to run. Others can walk, but I have to run. So for the world, 0 and minus is recession. For us, 6 and below should be recession.
Sure, Nilesh bhai. Let's hope the Fed plays the hero and they start cutting the rates soon, and they take the global economy running ahead. And but what do you think? Is the Fed going to cut the rate this year, or you expect the Fed to cut the rates next year? Because I think that is going to play a very important part, especially because the market was struggling due to Fed hiking the rates. So are we going to see the rate cut this year?
The US debt to GDP ratio is 120% right now. For 68th time, they are going to hit that $31 trillion debt limit. The student debt is now 1.6 trillion. Credit card debt is $1 trillion. Now, in this kind of heavily leveraged economy, can Fed afford higher interest rates forever? Answer is clearly no. They were late in raising rates because they didn't want to hurt heavily leveraged economy. Inflation didn't leave them with any choice, and hence they had to raise interest rates. Moment they get a respite on inflation, they will start cutting rates. The market is expecting that there is potentially one rate hike from here till June 23. And there are 3 rate cuts between June 23 to December 23. Now 3 can become 2 or 3 can become 4, but will 3 become 0? Extremely unlikely. Unless until Fed is intending to wreck American economy and suffer it, innumerable pain. Otherwise, they'll cut rates. I don't think Fed will take the risk of wrecking American economy, which is so heavily leveraged.
True, true, Nilesh bhai. Now coming to our theme for the presentation, your outlook for the equities for this financial year 23-24.
So Nikhil bhai, let's take first look towards 29-30, because somewhere in that 23-24 will come. IMF believes India will become third largest economy by 2028. We think it should happen by 2030. And some English institutes believe it will happen by 2032. But there is consensus globally that India will become third largest economy behind US and China over next 7 to 8 years. What does that mean? Between 91 to 2021, India created roughly $3 trillion of GDP and $3 trillion of market cap. The same GDP and market cap will get created from here till 28 or 30 or 32. Let's take 32 at the longest end. In 10 years, we are going to see what we saw in last 30 years. What was a slow motion movie, we will see now in a fast forward basis. That is the opportunity. I don't think so now there is need to convince anyone about long-term growth story of India. People who had written of India are also now believing that no, India is going in right direction. Then the question comes, if your long-term story is intact, what's going to happen from here till 24? This is where there is haziness in the picture. Our economy is doing better than rest of the world. Our markets have done better than the rest of the world. Unfortunately, we are also looking more expensive vis-a-vis rest of the world. So in the short term, can some people get tempted to book profit because in India there is exit, there is profit, and there is expensive valuation? If that happens, markets may consolidate rather than move up. There is also general election 24. If market believes they are going to get stable economy, it may move up. But if market believes that we are going to see a coalition government, then it will correct. So my feeling is that as an investor, I should be ready for the worst. From August 21 till May 24, let's assume there is no return in the market, like there's no return from August 21 to April 23. But that 3 years, zero return or moderate return or low return will get compensated in one day in May 24, like 2004. Or sorry, like 2009, when markets went up 20% in one day. So equity, it's difficult to take a 6 months, 1 year, 18 months call because there are so many events happening. But if we keep in mind that in somewhere between 7 to 10 years, India will become third largest economy. It will create as much money as we have seen in last 30 years. It will give you the ability to withstand period like today, where there is no return visible for last 12 months.
Point taken. I think, yeah, that's the challenge to predict on a short term, especially on equities. But the point which you mentioned, that market discounting the outcome of an central election based on past experiences, what do you think by when, say May 24, by when the market should ideally discount that?
It's difficult to predict that. It could be like 2004 when market was expecting India Shining campaign to get back Vajpayee government. Didn't happen and markets corrected 20%. Despite the fact that post that till 2008, we had one of the biggest rally in the market where market went up 7 times. In 2009, markets was not expecting higher majority for UPA government. Dr. Manmohan Singh government came with more number of seats and market went up 20%. Despite the fact that thereafter from 2008 to 2013, there was not much return. In 2014 election, market started factoring in that Modi Sarkar is coming. And from September 13 or October 13 to May 14, market went up significantly. So market is always trying to forecast future. When it comes When the actual result is as per the expectation, markets does not move. But when the actual results are against market expectation, positively or negatively, there is a big move. Now, we could see in the run-up to May 24 election a scenario like 2013-14, where market runs up ahead and then consolidates post results. Or we could have scenario like 2009, where market doesn't move up before election, but on election result, they goes up 20%. Or we could have a scenario like 2004, where market is discounting government to come back and gets a shock. So all results are possible.
Nilesh bhai, you're playing safe. These are the answers that we give. We have come to the magician for the pointed answer.
So that's where, Nikhil bhai, I'm saying that you don't take a 2024 call, take a 2030 call. No matter which government comes to power, will India growth story continue to move? The speed could be high or low, but the direction is unlikely to change. And this is the market where you invest on a 5-year, 7-year, 10-year basis, not on a 6 months, 12-month basis.
Sure, Nilesh bhai, one thing is for sure that, our investors and we are absolutely convinced on India's story. India's story has been going for long, and I think everyone in the room completely agree on that. The challenge which is coming is, last 18 months, investors have not made, in fact, they have not made any returns. And now they're losing out of patience. And, you're talking about May 2024, the scenario can go anywhere. And the dynamics also, of course, have changed in the sense, 18 months back or even 12 months back, the TINA factor was playing in. We did not have the alternative. There's no alternative because the deposit rates were at 4.5%. Now we are at TAMA. There are many alternatives because you have the deposit rates at 8%. Now, clients are asking, okay, should we sit at 8% debt returns, which are looking good? And if you look at the equity valuations, that is also creating a lot of questions. We are talking about currently we are looking at a P ratio of, let's say, 21. Now, is the market cheap? Doesn't seem like it's cheap, and especially when you have a higher rate. So what do you think on the valuation? Like, is it expensive? Should clients reduce the allocation towards equity? The fresh money, should they put in equity or debt? So what's your view on that, Nilesh bhai?
So Mukesh bhai, we have always told people that please follow asset allocation discipline. Whatever is cheap, you should be overweight. Whatever is expensive, you should be underweight. But don't make it zero, because it's very, very difficult to figure out what is the top and bottom of the market. Now, at today's level, interest rates are expected to come down, if not in 23 in India, certainly in 24. That means from here onwards, if you are investing in fixed income, either you will have higher carry or you will have a capital appreciation because of falling interest rates. So it makes sense to invest in debt. Does it make sense to disinvest equity? Answer is no. What if all the events from here till May 24 becomes positive? Russia, Ukraine gets settled as Macron and Xi Jinping are meeting in China. US Fed, because of SVB, decides to cut interest rates rather than raise interest rates. RBI follows Fed and says that now the pause is pivot and our next move will be cutting interest rates. The voters decide that, no matter what the noise is, we are going to vote for a stable, reform-oriented government. If all these events turn positive, where do you think market will be? The return which has not come for last 18 months will probably come, compensating for 18 months shortfall in just 1 month or 1 day or 7 days. It's impossible to predict market movement in the short term, as well as the events which are going to happen, and hence asset allocation is key. Our recommendation at this point of time, be marginally overweight large cap and be marginally underweight small cap. Keep some liquidity in portfolio, which can be used to buy small and mid cap in correction. In debt, go for as long duration as possible because rates are expected to come down over a period of time. That will give you good capital appreciation.
That's true. I think asset allocation is the core and always I think remain the core. And just to divert a little, and you mentioned about debt, so I thought let's just cover the debt portion here. With the latest tax change on debt, what is your view on future investment for debt investment, especially non-liquidity debt investment?
So, Nikhil bhai, yes, tax advantages have gone from debt fund, but there is anytime liquidity. That's not possible in most other instruments. In bank deposits, technically you have anytime liquidity, but there is a very heavy cost for the same. There is diversification. With as little investment as 500, you get 30, 40, 50 exposure. And there is professional management, which pays over a period of time. So tax benefits are missing. But other than that, there are many advantages. My recommendation will be that please consider equity saving scheme, which has between 10 to 50% allocation in equity. And it has equity fund status because it goes and invests into arbitrage position to get equity fund status. It will be more volatile than fixed income, but also deliver potentially better return. So on a risk-adjusted basis, equity savings scheme will be closest substitution for the debt fund, and it has potential to deliver better post-tax return because it is slightly more risky.
Sure, Nilesh bhai, that's very helpful because our clients are asking what to do, and even we are thinking how to allocate the money. And adding on to that, do you think, Nilesh bhai, because earlier people used to sit on debt because there was a tax arbitrage, they were comfortable getting 7-8%, 7%, let's say post tax. Now that yield will be post tax getting slightly affected. Of course, we'll have equity savings and arbitrage and various other stuffs coming in. But do you see incremental money from Indians moving more into equities because debt has become taxable? So do you think that equities are expected to get a tailwinds from this, and the multiples what India will trade at will be higher?
So it's a slightly tricky question. I don't want people to change their allocation because taxation rules have changed. You have to invest based on your risk profile and investment objective. Taxation rules should have very, very limited impact. Do I want Indian equity multiples to go up? Undoubtedly, yes. So I want people to increase more allocation to equity because equity is underrepresented in their portfolio. Only about 8% of or 10% of equity market cap is owned by individual investors. That's about $300 billion. Even if I assume that mutual funds are owned by retail investors, that adds another 8% into it. 18% of 3 trillion is $540 billion. What is this? It is less than our annual household savings. In a $3.5 trillion economy, there is about 15 to 18% savings by households. So जितना हमने एक साल में सेविंग किया है, उतना हमारा cumulative equity investment है. And that investment will also belong to HNIs than retail. So I want people to increase allocation because equity over longer period of time will give higher return. Our buying should increase India's valuation, but we should not increase equity allocation because debt funds taxation has gone up.
Correct. That's fair. Just one more point on debt. Do you think the interest rate cycle is peaked, and when do you see this interest rate cycle coming down in this financial year?
So today's pause by RBI was quite a pleasant surprise. Clearly, RBI is in a wait and watch mode. Our feeling is that subject to monsoon, which is likely to be adverse, inflation will come well under RBI's target range in FY24, whereas whole of FY23 it was above RBI's target range. With control on inflation, RBI's flexibility to support growth will increase. There is May 24 general election. There will be expectation that RBI will follow growth supportive measures. So my feeling is that somewhere once Fed start cutting rates, RBI will start supporting provided monsoon and inflation does not restrict that decision.
Yes, let's hope, Nilesh bhai, the rate starts coming down, and so that bond investors, the debt fund investors, they benefit and equity starts doing well. Now, talking on this, the new tax rule, of course, you explain, and on the debt, how that can be managed. But I think in this taxation of the debt, the international funds have also been caught in the firing, and now even international funds, they will be fully taxed. So what should a investor do on that? Because international, even your asset management company have international funds, and international diversification was playing out, was becoming important. Now that goes away completely. So is this happened by mistake from the government side? Because international fund was a very small bucket till now. You think government changing the rules, or we have to live with it? And if we have to live with it, then how do we do diversification in the portfolio?
So one, as MFI, we have reached out to both SEBI and Finance Ministry to, keep these rules only for debt funds and exempt or allow tax benefits like indexation for fund of funds, including international funds, if the underlying asset is equity. I don't know whether they'll look that into or not, but we'll continue to push. Right now, despite adverse taxation change, my recommendation will be to stay invested in international assets. We have two neighbors, China and Pakistan. In that low probability but very high impact event of a skirmish or war with them, local assets will get hit. Your international assets will be giving you protection. So there is a need for geographical diversification in our portfolio. Second, you can't take now money into global funds because of the RBI cap of $7 billion. If you withdraw money now, you don't have entry back. Hence, please stay invested. Third, globally, valuations have come off quite nicely. And I think this is time to stay invested, keeping in mind that in 6 months, interest rate cuts will happen. So from a valuation point of view, from a geographical diversification point of view, as well as from practical point of view, it makes sense to remain invested rather than take it out because of taxation change.
Sure, I think that's point taken. Nilesh, by coming back to equity, you mentioned that the allocation to overall equity, Indians equity is low, which is there maybe time immemorial. But within equity this year, what do you think, which sectors should we be looking at to be slightly overweight and slightly underweight, both?
So Nikhil, it is always the promoter within the sector which makes all the difference. In a banking sector, you can get Uday Kotak or Aditya Puri, or you can get Rana Kapoor, and the difference will be very, very wide. Subject to that caveat, we believe there are few sectors which should do well over next 12 to 18 months cycle. One is banking and financial services. Interest rates are rising. That means their net interest margin will expand. They'll have more profit. NPAs are at historically low level. So there is positivity on NPA side. And most importantly, FPIs were large owners of banks and they have sold that to book profit. So valuations have become reasonable. Reasonable valuation, stable NPAs, higher profit margin, banks become a buy. The second thing which is happening is manufacturing in India. Thanks to China+1, A lot of people are coming to set up their shop in India. A lot of people are buying from Indian companies. And this is suddenly making our manufacturing attractive. Capital goods, chemicals, manufacturing of other products, which have local as well as export market, they should do well. These are the two things, banking and manufacturing, where we believe there is opportunity in the years to come. One big sector, which is not like 1 year, 2 year, 5-year view, but a 20-year view. What we saw in IT was that we had engineers who could write programs. First, they got opportunity on Y2K, where they converted 2 zeros into 2000, and business started coming. And as Indian programmers became more and more competitive to rest of the world and started delivering quality service, our IT industry took off. Today, TCS has 6 lakh engineers on its workforce. Similar thing can happen in healthcare industry. 1/3 of doctors in America are made in India origin. 45% of medicine consumed by Americans by volume is made in India. In US, if you want to apply for visa, you have 2-year waiting period. But if you want to go as a nurse, there is a red carpet. The same thing is true in UK. A reasonably large portion of their doctors are made in India. A reasonably large portion of their medicine is made in India. A reasonably large portion of the nurses are made in India. Over a period of time, and I'm saying this is 5-year, 10-year, no, it is 20-year view. Will there be company emerging in India which will employ this healthcare professionals, doctors, nurses, which will use this medicine and medical equipments to provide service locally as well as globally, physically as well as digitally, onshore as well as offshore? Will there be a hospital company, healthcare service provider company employing 1 lakh medical professionals? Answer is quite likely. The world is aging. The doctors, medicines, and nurses will come from India. The world is aging and will require affordable healthcare. The cheapest healthcare in the world is coming from India at the same quality as global. So put all these things together, healthcare will be a sector to watch with a 20-year view, not with a 1-year, 2-year, 5-year view.
Nilesh bhai, you're always very positive. So you have only covered the positives. Which are the sectors which we should avoid for the next year?
Any sector where promoters are not, appropriate, they cheat minority shareholders, one should stay away. But from a sectoral point of view, where we are slightly kind of circumspect, one is IT. Globally, a lot of clouds are there, which may impact IT industry's order position or sales growth. So that's one sector where one will have to be a little bit careful. The second sector could be a kind of, let's say, agriculture related, rural sector related companies. If monsoon is bad, their business will get impacted. We'll take a firm view on monsoon around 15th of April, when Pacific temperatures will give a reasonable indication about El Nino severeness. If El Nino is light, then those companies will not suffer. But if El Nino is severe, then those businesses gets impacted. So agriculture, rural related sectors, if monsoon is bad, needs to be careful. IT industry in the short term, one needs to be careful.
Thank you, Nilesh bhai. Thanks for the insights on the sectors. I think it's really good. Let's hope the manufacturing and the healthcare have the Y2K moment, and IT is able to overcome all the struggles of the AI and the new developments which are happening. So now, Nilesh bhai, there's of course within sectors there are enough opportunities. Now, one common question which we get from our clients, of course, in the sense when we talk about equities, they ask for the return expectations. And, with the equities, we say in long term, maybe we can get 13, 14, 15% kind of return. But, investors have dil mange more also mindset, and which is fair enough. So if, let's say, some investors want 20% kind of return from the portfolio, so what can be done? Is it possible that investors can get 20%? When I say 20%, with a reasonable level of risk, not a risk where a capital erosion comes in, is there something which we can do for our clients, or clients can do, so that the expected return can go to 20% with, let's say, capital protection in long term? Of course, in short term we never know. So yeah.
So how do you generate extra return? Extra return comes by taking risk. There's no free lunch. Risk can be in the form of leverage. So for example, if someone would have taken leverage in March, April, May 20, he'll be sitting on a large profit, and his returns on his investment after leverage cost will be very, very high. The second risk is concentration. With the benefit of hindsight, if you had invested in, let's say, stocks like Bajaj Finance or HDFC Bank, they would have delivered far better return than index. So concentrated holdings of right stocks will also deliver you better return than index. The third is allocation. I don't want to take leverage, I don't want to take concentration, but I will move my allocation in first gear as well as fifth gear. Now, if you can do that at the right turn, obviously your journey will be far, far better. So between leverage, concentration, and allocation, one can take a call. But please remember, it's very, very difficult thing. To generate above market return, one has to be truly exceptional. What we should focus upon is generating real return. Whether it's 10, 12, 15, doesn't matter. It should be positive real return. Your wealth should grow higher than inflation. If that happens, that means you are becoming richer and richer every day.
Thanks, Nilesh bhai. Thanks for the insights on how to generate extra return. I have a add-on question to that, but before that, for all the audience, Nilesh bhai has a hard cutoff time at 7:30. Now, after this, we'll be opening up, the session for the Q&A. So if you have any questions for Nilesh bhai, you please put it in the chat room, and we will take up with those questions with Nilesh bhai. So Nilesh bhai, coming back to the extra return, I think thanks for the super insights. Every time I, have this discussion with you, I learn new things, and that's very helpful. Leverage, concentration, and allocation are the ways to do. Now, of course, these things are challenging, for a normal investors to do on their portfolio on shares and all. It becomes difficult. That's why the investors come to the professional managers like yourself to beat the benchmark returns, to generate alpha for them. And lately, what we have seen is that, like in US, the fund managers are not being able to generate enough alpha. And even in India, we see sometimes that, the large cap fund managers are not being able to beat the benchmark. So my question to you is that, do you think that the professional managers whom our investors are giving money, will they be able to generate alpha in the coming years? Is alpha there in the large cap, or should we replace them with the Nifty, which we have been doing to great extent? But what's your view on the alpha? Is because we give the money to you guys, so what's your view on that?
So Mukesh bhai, you have to give money only to those fund managers which are generating alpha. But please remember that if index includes stocks like Yes Bank, Reliance Power, then it will be difficult to generate alpha when those stocks are doing well and pulling them index up. Alpha will come only when those bubble busts, and fund managers which have not invested into that then will generate alpha. So to some extent, while analyzing alpha, do also look at the root cause. Is it because we have not invested in Yes Banks and Reliance Powers of the world? Or is it because we ended up being overweight companies like HDFC or Bajaj Finance or so on and so forth? At our size now, I still believe alpha is possible, but it will not be possible every period. There will be periods where we will be underweight certain stocks which are going up for non-fundamental reasons, and we will make alpha only when those bubble busts. So just don't go by plain number, go by the root cause behind that alpha generation or non-generation, and then take a call.
Thank you, Nilesh bhai. I think we are also learning how to dodge the question. Nilesh bhai, one question, a follow-on question on this. You have to pick one of these. All conditions are same. All are long-term, 10-year, and you have to pick one of these: large cap, mid cap, small cap. What would you pick? Only one.
For aggressive investor, I will say small cap.
Okay.
But if you are conservative investors, then large cap, not small cap.
What would you pick? What would you pick? Only one. Only one. No dodging answer. Only one. What would you pick?
I will go multi-cap way.
Okay.
Which gives a blend of all, because I'm not a very aggressive investor at this age.
Okay, great. Thanks. Mukesh.
Yeah, thank you, Nilesh. Thanks on that. We have questions coming in, Nilesh bhai. So Atit is asking, how does a retail investor judge how the fund manager perform? Because you said give the money to the fund managers, who are generating alpha. So how do we select the good fund managers?
So one, look at the portfolio and take a call. Is this portfolio going to generate alpha in future or not? The past performance is an indication, but not surety of future alpha. But the portfolio undoubtedly is. Now, if you see in someone's portfolio unknown names, then you need to be a bit circumspect. But if you see portfolio consisting of good quality companies, then you can be reasonably sure that alpha will come. So judge a person based on his or her portfolio rather than performance.
Sure. So past performance really doesn't matter so much. Looking at the portfolio is equally important. We have Mr. Balaji asking that you recently did your business cycle fund. Now, do you take care of underweight and overweight the stocks to generate better return?
So in business cycle fund, there are two approaches. One is top down in terms of which businesses we believe will do well. So for example, as I mentioned, banking and manufacturing, we are bullish. IT, we are little bit bearish right now. So that kind of allocation will be reflected into business cycle sector allocation. Then there is obviously stock selection. As I mentioned in banking, even if you are bullish, you would not like to go into Yes Bank. So stock selection is also important. Once we have decided our top-down sectoral allocation, it is combination of top-down, bottom-up together, which determines how business cycle will deliver.
Thanks, Nilesh bhai. I think we have a question from Mr. Madhusudan. Follow-up question on what you just mentioned on the large, mid, small cap. A small cap that's kept and held from Mr. Madhusudan, a small cap that's kept and held for over 16 years has given a CAGR of 10.5%. This reality, and what does this mean? Small cap delivers higher risk, higher return when a CAGR is just about 10.5% over 16 years.
So again, if you sit in a slow train, you are going to take more time to reach your destination. If you sit in a fast train, it may have more jerks, but you will reach faster to your destination. Now, 10.5% return in a small cap stocks look low compared to the risk you have taken. So if I look at any small cap fund, it would have delivered far higher return than that. So clearly the stock selection is not appropriate. The rewards are disproportionate to the risk you have taken.
Agreed. I have one more question from one of the participants. Retail, what's your view on the retail consumer sector for this year?
If you are taking just 1 year view, it's avoidable. Second, from a performance point of view, generally ahead of election, all political parties and government would like to put money in the pocket of bottom of pyramid, vote bank or consumers. these people have higher propensity to spend rather than save. As we go into the election cycle, there will be more money in the pockets of bottom of the pyramid, voters stroke consumers. They will go out to spend, and whether they spend on liquor, whether they spend on mobile phone, whether they spend on a food item, but there will be spending. And all those people who are concentrated onto the bottom of the pyramid consumption should benefit in the run up to election.
Sure, noted. I use one more question, quite interesting. Someone who has a corporate career and just planning self-employment, what should be his strategy given the current circumstances?
So one, you must provide some money in very, very safe instruments like, I will say, short-term funds. They have some ups and downs, but they are much, much safer compared to other funds. This money should take care of your 1 or 2 or 3 years of lifestyle. No matter what happens in the market, no matter tomorrow if there is a nuclear war between Russia and Ukraine, this money should give you ability to maintain your lifestyle for next 2-3 years so that you can focus on your profession or business and grow it. The worst thing for an entrepreneur is when their family feels that their lifestyle is compromised because you left your job. And no one wants their family to suffer. Less return is acceptable, but not lower lifestyle for our family because we took professional risk of entrepreneurs. At the same time, rest of the money needs to be invested in a proper manner so that that portfolio gives you staying power. There will be asset allocation principle on that portfolio so that your entrepreneurial journey can continue without too much of a trouble. At this point of time, that portfolio will be kind of marginally overweight large cap and marginally underweight small and mid cap. It will be long on duration with the expectation that interest rates will come down. And there will be some dry powder to buy on correction in equity.
Sure. Nilesh bhai, we are just now about 4-5 minutes left. Would request if you can give a closing remark on your views. Obviously, we have covered equity, debt, international, but your closing remarks on the market.
So, Nikhil, my limited point is that we are probably going to see event-driven market till May 24. Fed pivot, RBI pivot, oil price movements, general election results. There are so many events which will continue to happen in impact. Some will be positive, some will be negative. The worst case scenario for me is that August 21 to May 24, no or low return from equity, but then one good election result and 3 years returns will get delivered in just about a month. You have to play for that in your portfolio. Second, do remember what we saw in slow motion over last 30 years in terms of opportunity. The same opportunity is going to get repeated in next 5 to 10 years. Again, this is the size of the opportunity, not the percentage return, because $3 trillion on $300 billion is 10 times return and 6 trillion on 3 trillion will be 2 times return. But size will be 3 trillion. What was slow motion will become fast forward. Please keep that in mind. There is one advertisement of a Swiss watch, Patek Philippe. I hope I'm pronouncing the name correctly. They say that you hold this for your next generation. You don't own Patek Philippe. You are custodian for next generation. Same thing is true about Indian equity. We are mere custodian for our next generation. We just have to deliver to them this great India growth story in the form of quality stocks portfolio.
With that, I think everyone is going to ask their previous generation, where were you when equity was to be invested for the next generation? Thank you, Nilesh bhai. I think I'll take this opportunity and thank all the participants, all our clients, well-wisher who have joined this call on a Thursday evening, and we have a long weekend ahead. Nilesh bhai, thank you so much for your inputs. I would like to add to your credentials given by Alpha Capital that you are a Bollywood star. I would like to add one more thing, that every answer of yours with the data points which you have given, I think it's like a hero giving a hit movie. So every answer of yours is a hit movie, and I think there is no Bollywood actor today who's given consistently so many hit movies. Thank you so much, Nilesh bhai, and we look forward to many more interactions in times ahead. And thank you all for joining. Mukesh, over to you.
Thank you, Nilesh bhai. Thanks a lot. Really
Thank
appreciate
you.
all your time. And I think it's a masterclass every time we have this session. And let me tell you, Nilesh bhai, our clients, they keep telling us, please bring Nilesh bhai. And that's why we don't do a lot of webinar with our clients. We only do few. In fact, in last 1 year, we have only done one, and that's with you. And we take your insights very seriously, and we're going to implement what you have suggested. Thank you so much. And I
Thank
also
you
want
so
to thank
much.
all our clients for taking out time. Have a fantastic long weekend. We have a Friday, Saturday, Sunday off. Have a fantastic evening and a long weekend. Have a super time with your family. Thank you so much, everyone.
Thank you.
Thank you.
Thanks a lot. Bye.